So Basant Maheshwari is now with us. He's a special guest. Basant, last year, exactly same time, 12:10 p.m. I asked you 12 years. And what's your view for the next 12 years for the market? So today the question is, it's 13 years now for ET now. You've always been a part of it, especially the anniversary day. What's your view for the next 13 years?
Pankaj, first I want to spend the next 13 weeks without worrying. So if I can spend that, I know money will be made. Money has been made before, money will be made. But the problem is when you are stuck in a situation like this, your mind cannot think beyond 13 days, 13 hours, 13 minutes, depending on the kind of trades or investments you have made. But yes, over the next 13 years, people will make money, not from the same stocks, not from the same sectors. New trends, new things will emerge. What will emerge, no one knows. But when it emerges, you'll be able to catch them. But the basic problem is right now, about information flow. There is so much of information flowing everywhere. I'm not talking about Ukraine, Russia. I'm not talking about interest rates. I'm talking about the general format in which information flows. So you've got a WhatsApp, you've got a Twitter, you've got a Facebook, and everyone knows the news at the same time, and everyone wants to get in from the same door and exit from the same door. So because of that, I think the permanent concept of stock markets being stably consolidating and trending slowly higher is giving way to volatile returns. You have to churn this.
Yes, and there is a lot of noise in the market, so perhaps that's the reason you should be watching out for ET now, because this is where you will get the real information and not those noises and a lot of buzz. But Basant, talking about, what we are seeing in the market right now, capitulation in the broader markets, etc. What's your view in terms of where the market is headed? Have we already priced in the worst, and are we close to the bottom?
I thought we priced in the worst when 75 basis point rate hike happened in US and the markets rallied. But suddenly you got the new one from Swiss Bank who said we're going to hike rates by 50 basis points. So when news flow moves that fast and that quick, and the basic problem in a high interest rate recessionary environment is right now we're just seeing interest rates going up. We have not seen corporate defaults. You've not seen people going bankrupt. We're not seeing credit card defaults. I'm not trying to create a scary scenario. I'm saying these will come as part of it, but then you will have to price it in. And the good part about that WhatsApp and the Twitter community is everything gets priced in within hours, within a couple of days. So if you got a news floating for 2 days, it's well priced in. So I think we are pricing in the situation, but then the problem is you get a new set of bad news and then you have to go and price that again.
Right. Basant, when we just talk about the markets, how things are moving in, one of the investments that you've always done is high P, high growth, look at quality names, try to create multi-bagger. When we look at Titan, when we look at DVs, when we look at Asian Paints, you think that trade is really changing in?
It does look like changing. And I still remember when the BJP government was voted to power in 2014 and you had all those MTNLs and the ITIs rallying and people said, ye high P ka zamana khatam ho gaya hai. Ye growth ab nahi chalega, ab sirf value chalega. I mean, things don't change in a year or two. Things have been there for decades and they will be the same. But where is the growth in a high P? I will buy a high P, 80 P stock when I can see at least a 25% growth. An 80 P stock with a 12% growth means if the PEG were to go to 1, you will have to spend 5 years of sideways zero returns. And that's the risk in buying a high P. You don't buy a high P for quality, you buy a high P for growth. Because at the end, markets pay for growth. So the growth element is missing in most of the high P stocks right now. And obviously when the economy is into these kind of situations with high interest rate environments, the growth will take a backseat. But this is a 1-2 quarter phenomena. For equity is supposed to be a friend forever. But we try and test that friend every second day by looking at what the index or what the price is doing.
I mean, come on, Basant. I mean, every time a high P stock goes into numbers, there is always this, will they deliver again, will they not? Is enough. I mean, the markets also have to give their test, right?
No, that is because most of the funds don't want to underperform even for 1 month. So when no one wants to underperform even for 1 month or 2 months, most of the long only funds, most of the investment funds have actually become traders. And that's a fact, not just in India, it's there globally. So I don't want to buy a stock which is not going to perform for 6 months if I'm running a fund, because my investors will withdraw, my distributors will be under my skin. So those are the problems that you take on with. But if you're an individual investor, how does it matter if the stock doesn't go up for 6 months? You can just keep holding it as long as you are sure that the growth would come through.
Back to the earlier point that you made regarding growth, that you're willing to bet on counters which are delivering growth. And one such sector is IT, right? Companies are talking about double-digit growth. The optimism that we are getting from the management is really high, but that's one of the worst performing sectors of the year. Why is that? Why are people not then giving the valuations or buying into that particular sector?
No, so the first thing is, if there is an IT situation, the basic problem with IT stocks are, you look at the NASDAQ and you go and start selling IT. That's it. So that's for the morning trade. Over a longer period of time, if US goes into recession, then obviously you will have a situation where people will cut down on some spending. But then there is so much of innovation happening in America that you cannot have in America innovating without India being used as its outsourcing back office. So results would come through, but then most of the IT stocks had been bid up at 40, 50 times, but not now. They're down 40% from the top. See, great companies don't fall more than 40% without a reason. If they've fallen 60%, and if you are sure that the company will survive over the next 5, 7, 10 years, then that's broadly the bottom. So most of the IT stocks are down 40% because America is supposed to be going into a recession. It's not yet gone into a recession. You're just pushing it into a recession. It's like a bridegroom who says, I don't want to marry, but we say, nahi, ja, tu shaadi kar, tu baith hai, tu shaadi kar, because hame khana hai. So it's like that. So there's no recession right now, but we're assuming that there'll be a recession because interest rates have gone up. And yes, obviously, when interest rates go up, people have seen economies going into a recession. But at this time, it's too early to take that call.
And which are these companies that you're talking about? Is it the traditional IT names, your likes of TCS, Infosys, etc.? Are these those mid-caps which are growing at a faster clip? Or these are the new age tech companies, completely different disruptive companies, the likes of Zomato, etc.? Which would be your top bet?
So the likes of Zomato are like a teenager who have a nice time based on the pocket money they get from the dad. The dad in this case are the PE funds. So you don't want to be betting on those companies. TCS and Infosys are the senior citizens, the pensioner people who have made all their money, their life, and now they want to enjoy life. You want to look at the mid-cap IT names, I think those are the places. I don't own them. I can just give you a reference point just for viewers to go and understand. Maybe a Mindtree and LTI and LTT, something like that. This category of companies, they're growing at 25%. And when the economy is in a bad shape and when money flows back to America, very soon you will have a dollar going up. And you do this study, I don't know why and how and for what reason, the dollar normally appreciates against the rupee 1 year before the elections. So you are approaching that scenario where the dollar should normally do better and should appreciate against the rupee. And these guys will make a little more money at that time. So the mid-cap IT, the flavors, the stocks that are going 20, 30%, those are the stocks to normally look for.
Right. So, Basant, one would say that commodities did well because people were playing the inflation trade. So companies that create or lead to price hikes, that's something which you're looking for, not like HUL and Nestle, but maybe a steel company or a metal company. Now, most of the central bankers have taken a note of inflation. There have been a lot of efforts towards this. Markets itself have created a problem for demand, and demand should come down or it should not be as high as what it used to be. How would you play the reverse trade? What are the best sectors to play this?
So think, Pankaj, is central bankers cannot create supply. They can destroy demand. That's what they do. So it's like a child comes to you and says, I want to buy this book. And if you don't have cash as a father, you'll say, Jo hai usme hi padh lo, nahi kitab kharidne ki kya zarat hai. And you might say that's a wrong thing to do. I mean, central banks, if they hike interest rates, and Volcker did that about 40 years back and everybody knows it, to 20%, you think Russia is going to reduce the price of crude by even $2? No, they won't. But that's the situation we are in. They can destroy demand. So when housing loans in America, people who had booked at 3% are now being asked to take up a housing loan at 6% over the last 4 months. So at 6%, no one's going to buy a house in America. The housing is going to be in a slump. The Fed created this bubble. They created demand during COVID times through stimulus. Now they're destroying demand because there is inflation. I think it's a musical chair game. Once they destroy demand, once there is going to be a recession, then they'll say, okay, demand has been destroyed. What do we do now? Okay, let's give them some more money so they can create demand again. So it's like what you say, there is this Madari in the dance happening where the Fed doesn't know what to do because basically there is so much of debt in the system, but they're trying to tinker around with demand depending on the supplies that you get. To the second part of the question, what are the stocks to bet on, sectors to bet on? I think metals, the game is over, at least for the next few years. I don't think it was a stimulus trade. It happened. People made money. People couldn't keep what they made. You lost 20% from the top, but still you're out of it, and that's good. You shouldn't look at metals again. They will appear to be cheap because you're looking at them on the basis of historical earnings. The moment current earnings come in, it will price in all the fall that these stocks have seen through. HUL and Dabur, we don't own them, but these are classic companies where they will pass on the cost in the current year. So once they pass on the cost, then a toothpaste from 60 rupees never sells at 55. It always goes from 60 to 62. When they pass on the cost, the incremental savings, because obviously the input cost will come down, will translate into higher EBITDA margin. So I think if you are very patient, want safety and want a good trade, or an investment, you should look at these stocks like an HUL or a Dabur or a Nestle, not Nestle for that matter, maybe an HUL and a Dabur, because they will pass on the cost and they will hold on to it, and costs have to come down. That's why interest rates are going up. So these companies will do well over the next 2-3 years, and they're also very, very protective of your capital if you're buying these type of companies. So these are the companies that you can look for. But if you're really looking for some adventurism, then I think the consumer discretionary, not now, maybe after 6 months. But for now, it's a very difficult wicket to bat on. The ball is swinging both sides. Even the baller doesn't know which way the ball is swinging. So it's so difficult. So you have to play it on.
Let's take it the other way around. Let the ball swing wherever you can. You can just hit a six, and I'm sure there'll be a lot of runs also to be made. Not only wicket will go, but even a lot of edges will fly down. So what will be that sector? Which will be that high growth, high sector that Basant would look at? HUL, Dabur, they're not high growth, high PE anymore.
No. HUL, Dabur are not a high growth.
Exactly.
So yeah, I know. So in our community normally, I can tell you through an anecdote. So it's like it says, like a company called Tata Motors DVR. We had it, we sold off. Now we'll look to buy it again. So this is called a poor man's Tesla. So when marriages happen, they say कि लड़के का मामा बहुत अमीर है, इसलिए यहाँ शादी करा दो इसकी. So Tesla is बहुत अमीर, but you can't buy Tesla. So you can look at Tata Motors DVR because लड़के का मामा बहुत अमीर है. So that concept plays on. And if crude goes to 200, you'll have more EVs. But I would like to see Tata Motors DVR. Tata Motors, a company, actually put on the gas. But then they can't do anything because the chips are in short supply. They would be sorted over the next 6 months. You don't assume a chip shortage to continue for the next 5 years. So these are things that you will have to see if you're going to buy a stock, because you will have to have a longer term view. And for the moment, stocks can go up, they can come down. Somebody might be selling, somebody might be liquidating his portfolio. How does it matter? If you can have the holding power, you will make money.
You're talking about adventurism and all, and market is giving you enough adventurism already. I don't think any of us can take any more volatility because it's been a complete roller coaster of late. But just to scratch that point further, when you're talking about the auto companies, now Tata Motors has become a bit more discovered stock. Last 6 months, we have been, seeing that entire shift from in the PV space into EV, and it's getting a lot of positive response. Do you think it's time now to look at other companies like M&M, etc. as well from the auto pack?
M&M, again, you're struggling with the old concept. You want to buy something in a new sector where the sector is going to dominate over the next 5, 7, 10 years. And that is why I would say that you should look at companies that are changing the format. And plus, Tata Motors DVR is the best hedge against Vladimir Putin. So if crude stays at $120, people would go to EV. Then you can say, how are you going to generate electricity? But then for the moment, it's fine. So that is why you have to look at these kind of companies where you look for a 5-year view or a 3-year view. But if you go to 1 or 2-year view, then obviously you should look at companies like HUL or Dabur. But then, yeah, like Pankaj pointed out, you won't make a lot of money buying HUL and Dabur, but you will make decent returns.
All right, Basant, thank you so much for joining us.
Thank you,
And always being a part, at least for the last 6 years, he's always joined us on the anniversary day. So thank you so much for always being a part of this special day at ET Now.